Hello, and welcome back to the Governance, Risk, and Compliance Conference. Our first session of the day is worth 1.5 continuing professional education credits. Please be sure to enable your media player to hear audio. To be eligible for CPE credits, you must answer at least 4 of the 6 polling questions during the webinar and have a total viewing time of at least 75 minutes. In accordance with the standards for the National Registry of CPE sponsors, CPE credit will be granted based on a 50-minute hour. We are unable to grant CPE credit in cases where technical difficulties disqualify eligibility. CPE program sponsorship guidelines prohibit us from issuing credit to those not verified by the technology to have satisfied the minimum requirements listed above. I encourage you to download each session's presentation, which is located in the Resources widget on the lower right-hand side of your screen. After the conclusion of the session, your CPE certificate will be available in the certification widget and will also be emailed within 24 hours, should you meet the criteria. Below the speaker's biography widget is the Q&A box. Please feel free to ask as many questions throughout the presentation, and the speaker will answer as many questions as possible. Now it's FEI's pleasure to introduce our moderator for today, Steve Richard. Steve?
Great, thank you. Good morning, everyone, and welcome to day 2 of our virtual conference, Governance, Risk, and Compliance in a Riskier World. We hope yesterday's sessions provided you information you can bring back to your companies and use as you navigate the difficult challenges we're all facing. I had the pleasure of introducing myself yesterday, and again, I'm Steve Richard. I chair FEI's Committee on Governance, Risk, and Compliance. I'm also the Chief Risk Officer for a large multi-billion-dollar med tech company, so I'm living this every day. I'd like to share with you just a moment a little about our committee. So the CGRC provides a forum for FEI members to stay connected about the latest developments and trends in corporate governance, enterprise risk management, and compliance. It also offers members valuable networking opportunities and the ability to share experiences, ideas, and best practices with industry peers. Our meetings feature engaging discussions on current challenges, trends, and best practices. Sometimes we bring in an outside speaker, sometimes it's just us, sometimes it's a mix, but always I find value in what we're doing. We are really creating a community of practice for governance, risk, and compliance professionals, and I use that phrase often, a community of practice. Our goal over the next year is to meet through scheduled conference calls, and when it's possible again, hopefully sometime in the near future, to meet again in person. We had a meeting last week or the week before. The time gets confused, as you all know. We shared return to work efforts at our respective companies, and the meeting really was well received. So, if you're in a GRC role at your company and you're an FEI member and are interested in joining the CGRC, the Committee on Governance, Risk, and Compliance, please indicate your interest in the chat box, and someone from FEI will reach out to you. That's my promo for the day. Now let's get to our final day of Governance, Risk, and Compliance in a Riskier World. And with that, I turn it back for a small intro. Or maybe I don't. Maybe I continue. Okay, I think I continue. While CFOs and Treasurers are tasked with being productive and operational while working remotely in the current social distancing environment, they're also focused on answering critical questions from CEOs and the board around cash and liquidity. Our first speaker of the day, Wolfgang Koester, Chief Evangelist of Kyriba, will share some best practices you can use to answer strategic liquidity questions and meet CEO and board expectations. With that, Wolfgang, please take it away.
Hi, Steve. It's Kelly again. We have two quick polling questions before Wolfgang starts.
Okay.
Our first polling question: what are the biggest concerns your organizations are dealing with? Cash forecasting in uncertain times, emphasis on liquidity, currency voltage, all of the above. Be sure to hit the submit button when you select your answer. I'll give you about 20 to 30 seconds now Now's a great time to also put any of your questions in the Q&A box. All right, we'll be wrapping up in the next 5 seconds or so. Be sure to select your answer. This is for the CPE, and hit the submit button. We'll be moving on. All right, so here are the results. Looks like about just under 43% says cash forecasting in uncertain times, emphasis on liquidity. Currency is about 5%, and just under 33% say all of the above. And now we'll be moving on to our second polling option. Boards are now asking atypical questions such as liquidity projections. What are your boards asking you about today? Cash management, working capital, payments, foreign fee exchange management. Be sure to select your option and hit the submit button. Again, put your questions in the Q&A box. You'll have about 20 to 30 seconds. All right, we'll be wrapping up now. Make sure to put your selections and hit the submit button. And here are our results. Cash management, just under 63%. Working capital, just under 32%. Payments, just under 6%. And foreign exchange management is just under 1%. Okay, and with that video conclusion, Wolfgang, if you would like to start now.
Absolutely. Thank you very much. Good morning to everybody. I am reminded today actually is the 2 months of quarantining from my home. Exactly on this day 2 months ago I started, and certainly it's given us a lot of time to reflect and really to think about where we are and what lessons we're learning. And we have, while not traveling and face-to-face seeing many of you as well as your colleagues around the world, we've had the chance to really take a look at and talk with a lot of our customers, as well as you'll see through this session, get some results. So the way I'd like to do this today, since this is 1 hour that I'm pretty much talking, is I'd like to start off with a process where we are in the process of writing a book And the working title of that book is How to ITAR in Finance. Now, you probably ask yourself the question, what is ITAR? And it is how to innovate to achieve results in finance. And so the next 6 areas that I'm going to be talking about is really think about them as chapters. And of some of them, I will have suggestions about what you may want to think about that can help your organization innovate in finance during these times. So I'll be talking about digitalization and, quite frankly, what I refer to as the API, what we refer to as the API superhighway. We'll talk about board of directors' focus on liquidity, from the sleepy quarterly reports to the daily updates and scenarios. We'll actually focus on 8 key risks from boards of directors that we have, and CFOs and CEOs, that we have gathered and resulted into a threat matrix and assessment through talking to a lot of our customers again. Then we will talk about the present and how the coronavirus in this area has pushed us into the future of liquidity. If I get to it, we'll hope to have 4 main areas of liquidity as business cases, and I'll finalize with the challenge on top of all this that I think you're all going to be facing with respect to ERP migrations. So with that, let me jump right into it. Digitalization has been accelerated through COVID. This is what we refer to as the API superhighway. And it is all about, if I would put it in basic terms without having to go through all these buzzwords on here, it is all about at the key, at the focus, at the center. It is about liquidity, as I'm sure many of you are going through, if not all of you are going through right now. And the superhighway is really the connection to create an active network around liquidity. And the active network is, to me, a super fast and increasing highway that's 2 ways. One, any and all data coming into the organization, being processed at the organization, and then actions, resulting actions getting pushed out into, again, the network. So incoming networks could be your bank statements, can be your ERPs, can be various data sources. Then having the AI around it, the automation around it, and pushing out decisions into the network that is in its process of being reinvented and, quite frankly, further accelerated, as well as activated. Here, it's really important that you need to assess where you are on your journey of better data to better decisions. Are you still on the surface road? Are you entering the freeway? Or are you already on the superhighway? And I will go through some of the discussion points that you may want to think about discussing with your organization. As these surveys here, you will see, okay, go ahead. So what we're doing here on an active liquidity planning, and I'll push this back over from a polling point of view to you.
Great, thank you so much. I am planning to adopt an active liquidity strategy for my company within 6 months, 1 year, more than 1 year. I do not plan to adopt an active liquidity strategy. Be sure to hit the submit button when you select your answer. Again, this is a great time to put your questions in the Q&A box. We have 20 to 30 seconds here.
And we'll educate you more about active liquidity networking throughout this session.
Okay, we're getting ready to wrap up, and I'll move to the results. And here are the results. 6 months, about 44%. 1 year is just under 21%. More than 1 year is just under 6%. And I do not plan to adopt an active liquidity strategy is just under 31%. And back to you, Wolfgang.
All right, thank you for that. So while we're going through these things, there have been numerous surveys done with respect to what strategic challenges do corporations have. And they start off with the clearest one at 62% of visibility into global operations, cash, and financial risk exposures. Going to liquidity, I think some of you have already agreed with that through the last 3 polls that we've done today, into FX volatility, and so on. So as we're going through this thing, and I want to keep things moving, here are 2 suggestions that you may want to think about as you're addressing the core, the company bloodline liquidity. A, what is the API strategy that you have currently? Is it reactive or is it proactive? And if it is reactive, are you doing it purely because this is our largest bank? Or are you thinking about connecting to the organizations because these organizations are giving you better information and are getting you better data and better connectivity? So that's a tough one to go through, but a takeaway for you should be to think about a true API strategy if you don't already have one. A lot of you I've met have not really formulated an API strategy, and I would strongly suggest you think about that. The second area throughout this, given that this is such a strong survey here, is what areas need closer collaboration in finance. And with that, I'm really referring to is, are there still silos? For example, is working capital and supply chain finance really working on its own? Or when it does cross-border payments, or the cross-border payments integrated into a overall risk management strategy? So really thinking about within all of your liquidity, do you have one big team that really well collaborates, or are there still outside areas such as payments, supply chain financing, foreign exchange risk that are independently managed? So those 2 takeaways I'd suggest given the scenarios that we have. Going to the next part, which are the board of directors. Here we have another question. Has your company adopted a cloud-based solution? Sorry, so go ahead with that. Sorry.
Thank you, Wolfgang. Has your company adopted a cloud-based solution? Yes or no? Be sure to hit the submit button. We'll have about 20 to 30 seconds here. Okay, we're getting ready to move on. Be sure to submit your answers. And here are the results. Just under 63% say yes, and just under 38% say no. And back to you, Wolfgang.
All right. Still a lot to be done. Perfect. I remember about 10 years ago, I was in Germany, and a lot of companies had still said, there's not a chance I haven't got cloud-based technologies, and now everybody's moving in that direction. So I think it's terrific. It's terrific result to already see as this is moving forward. As we're talking about board of directors focus on liquidity from sleeping quarterlies, et cetera, I'd like to emphasize a couple of things that the next slides are really based on. One is we're very proud and honored to serve over 2,000 corporations around the world. All are helping us to innovate to achieve better results for themselves. Around the world, we also have 700 plus colleagues that are passionate about innovating to achieve results. So here, we've been really heavily focused on what are the questions that we are getting from our customers over the last certainly 2 months. I think today is probably the date of the 2 months, but there's some leading ahead of it. So talking about the scenarios of do we have enough cash for the next 7 to 14 days or 30 days or 6 months? What is that? What are we thinking about? Can I trust my liquidity forecast right now, given that a lot of companies are being asked to really think through their model and moving that along? So the issue here is, what are the scenarios? So we've seen the largest companies. Now, I was on the webinar with one of the largest beverage producers in certainly the United States, where treasury and CFO said to us, we used to produce a report on a quarterly basis and everybody kind of paid attention to it. It's a pretty cash-rich firm. Now they're getting questions every single day. These are some of the example questions that I encourage you to start thinking through about, did I really have all the answers to these questions? So as you're thinking this through, and as already a poll question has shown, is we are seeing from our customers and prospects, quite frankly, an increase in all these 4 areas that emphasize liquidity. And the key is, as these boards are asking questions about that, is that they're working as a team together, that this isn't supply chain finance isn't standing by itself, payments isn't standing by itself. But what we're also seeing is that Treasury, who's coming to us first typically still, has become much more of a strategic coordinator of data, gathering it, providing it, and then being able to get actionable within finance. And with that, we have another poll.
Did the COVID-19 pandemic change your opinion on the importance of cloud-based solutions? Yes or no? Be sure to hit your submit button. We have about 20 to 30 seconds here. All right, getting ready to move on. And just over 44% said yes, and just under 56% said no. Back to you, Wolfgang.
All right, thank you so much. So now here we come to a core part of the presentation, and we refer to it as the risk and threat matrix. Again, lots of customers' input here that I'd really like to share with you here. So as you're thinking about this thing, is that we've seen 8 categories that boards and investors are frequently asking CEOs and CFOs about, and quite frankly to treasurers to report on, and which ones of these are you thinking about? So we'll start with the, for example, as a center, control and risks. And by the way, the next slide will have some answers towards these, but these are great guidances for thinking about your own threat assessment, which we'll get to later. But really what we're thinking about as controls and risk, the number one thing that came out was that of competency reduction. So what happens if we have competent people who, for example, are falling sick? So certainly a human resource aspect of finance was right at the top of the list. Not surprising. People are still the key part of this. Secondly is the internal processes and tools. Here we're thinking about business continuity issues. Third, we're talking about delayed cash collections and uncertain revenues, liquidity and stability. Fourth, fraud. Fifth, foreign exchange interest rates. 6, debt and counterparties. 7, costs. And 8, supply chain. So the questions here are, these are summaries of main issues that corporations told us about that they were facing and really had concerns about and needed to figure out how to address in this sequence. So let's take a look at some of these ideas, and then we'll come to a conclusion on this thing. Sorry, there was, I guess, a couple animations there. All right, so how do we address these risks? So when it comes to the human resources piece, as the top right there, absolutely process automation was key here. Really having people shift from really gathering data to the automation of gathering data so that they can make better decisions, and really automating these manual tasks as an answer. Secondly, as we're thinking about internal process and tools, expanding the reliance on business continuity was a significant answer of this. And as we go through these, and I encourage you to really take a look at this because I don't want to read every single one of these for you, I encourage you to really think through what organization can help you, maybe externally, to actually assess the threats that have been created and how to address them. This is something that we've seen a lot of questions on. We've been asked to do a lot of assessments on that. We used to charge for these, but right now we're actually doing those as part of helping in the liquidity for free. But if not Kyriba, then others can probably help you do this, but based on a lot of corporates and a lot of work has gone into assessing the threats that are created via this new environment that we're all living in. As a next step, moving right into that part then is, what I'd like to spend time on as next is that part of where is the present and future of liquidity. And here I'd like to really focus on two areas. One, where have we come from? And two, as being currently where we are, is what have been the inputs that changed it, and what did Deloitte, for example, show as results? And so let me go on to that one. So as a first part is, when we started our journey led by our CEO and visionary Jean-Luc, we really focused on really gaining visibility on behalf of the customers to all their cash. And he felt very strongly to go back to ITAR, innovate to achieve results. That results would be pretty impactful if one could at any time have visibility to all cash positions. So that started off the journey from cash management into treasury management, and a lot of people still know Kyriba as simply a treasury management system, though we have evolved certainly into an active liquidity networking company where we address not only treasury but any sort of finance solutions, to extending the treasury value towards the active liquidity network as you see it over here on the right. And the active liquidity network has become, and management thereof has become very strategic, because at the end of the day, it is not just pulling in what the ARs and APs are and what some of the risks are, but really thinking through the four pillars of the active liquidity network, activating that network of liquidity, and the API superhighway that's associated with that. So thinking this is where we now have ended up. We are really in this era of active liquidity management that we're enabling with lots of people to achieve results. And as such, we did a webinar not too long ago with Deloitte, where we actually talked about how does one navigate through today's environment for tomorrow. And some of the things that we've seen is obviously that the cash flows, for example, have dramatically changed, that you've had strengthening of the US dollar, you have business continuity issues, and quite frankly, a lot of companies have to reevaluate their business model. That isn't just related to restaurants. And some are in good shape. Technology firms can continue to work home. I think there's been some announcements from the Microsofts, the Googles, the Facebooks, et cetera, that they'll be working from home till at least October, or maybe even as through the rest of the year. So what does that mean? How does that do that? And how do they innovate to achieve new results given the new environment? And so as you look at these areas, is one has to recover and plan for post-crisis transformation. And that's the gist of all of what we're all talking about. What does that look like? And here are the suggestions that I really think strongly you should take with you and really check on whether you're achieving these and whether you need support in achieving those as well from wherever you're getting that. That achieving improvement of integrated liquidity solutions, of advanced scenario analysis, of enhanced digital capabilities. Quite frankly, there are serious opportunities to save money here as well, and to optimize securities, controls, liquidities, as well as risk reward. I may give you one example here. When one goes to, for example, the risk pillar, that has significantly changed in, for example, foreign exchange, where one always has to compare interest rate differential with the risk of the portfolio of currencies impacting the organization. So as such, the question then becomes is, What has happened to risk? Well, we all know what's happened to risk. It's gone significantly up. Volatility's gone through the roof. But interest rate differentials have changed significantly. So what we've seen, lots of companies, when we run those analyses for them, we've seen that the entire risk-reward or risk-cost profile has materially changed. In many cases, especially for American corporations, U.S. dollar strong based, to actually have a higher currency risk, yet a much lower cost due to the interest rate differential of actually managing that risk. So that's a very interesting analysis. Where I was just looking at a company that was spending, prior to COVID, $800,000 on interest rate differential on a $26 million risk. While the risk has over doubled, the interest rate differential to manage that risk has more than halved. So they were actually looking more like $250,000 of interest rate differential to manage a much larger risk. So how do you navigate through those? What's the technology you have? How are you getting at the data? And how are you then forwarding that? So with that, I'd like to actually spend a little bit of time. Hopefully I'm giving you some ideas, some thought-provoking ideas, and have time afterwards to really dig into these. But what I'd like to do now is really look at four main areas of liquidity and look at some business cases associated with those. So let's start with first, active liquidity. And really here we're talking about the recipe for finance in a pandemic. CFOs have tough balancing acts right now, as I'm sure you all do, to actually pursue strategic growth while minding the right levels of risk. So the idea here is becoming, again, is how are CFOs addressing this? They're addressing this in part by elevating treasury. We talked about earlier about having treasury much more strategic and a coordinator of lots of data that touches liquidity in order to make better decisions, to really identify and actively orchestrate all sources of liquidity. I think it's really important here to recognize that liquidity goes way beyond cash, as we all know. Certainly debt is part of that liquidity, assets are, but we're seeing an increased amount of questions that have never been asked before. For example, a ratio on covenants is where you look at a liquidity ratio, which used to typically be assets divided by liabilities, and now we're actually seeing that people are saying, well, we don't know what you're doing with the inventory, so we'd like to look at the ratio of assets minus inventory divided by the liabilities. And the people that are able to communicate with their lenders these sort of numbers quicker and with confidence gain more confidence by their lending institutions and therefore have access to liquidity much quicker. And then really here, it's really important to ensure that this is not one channel, but this really is an interconnected wave that can really see liquidity, move liquidity, protect liquidity, and quite frankly, grow liquidity. So let's look at an active liquidity network a little bit closer. So within this liquidity active, and we already just talked about the active liquidity, we have four areas. We have the active risk, we have the treasury, we have the payments, and the financing. And activating all this means you need connectivity on the left to your data, whether they are ERP systems or others, to the right to banks, financial institutions, as well as gaining your information out of banks as well. So that's not a one-way. We know all that. But then how do you actually optimize that and connect these areas to maybe multi-dealer platforms, single platforms, who's giving you the best liquidity, et cetera. So I think this is a very good depiction about how you should think about an active liquidity network and thinking about liquidity in a finance organization, and really think about these four pillars, and I'll talk about a couple of them moving forward here. Really think about these pillars as you are leading your finance organization. So if we look then as the next one, as an active risk, talking about foreign exchange exposures, we have seen companies being able to reduce their net corporate FX up to 50% by using technology to do it. The benchmark still remains, even in these times, the benchmark still remains 1 cent earnings per share impact. If you have more than 1 cent earnings per share impact by balance sheet, a lot of analysts are telling us that they're looking at that as an indicator for other risks that may not be as well managed as they would like to see. We see, as a result of actually applying better technology, for example, on the cash flows as well, an improvement of at least 25% in absolute terms of the cash flow hedges. Now, in these times, we are seeing much more emphasis on the balance sheets, obviously, the monetary assets and liabilities, and less of an emphasis on cash flows. Interesting in this area, and you should discuss this with your bank if you already have programs in place, they have products where if you have hedges that are underwater, where you may have to put up cash in order to create that liquidity, they can actually re-forward that hedge, so to speak, without you having to pay or bring up liquidity by just keeping the spot ratios in order to keep more liquidity for you. So these are some of the innovative products that we've seen in NetWest and some of the banks really coming out with, that the Barclays of the world coming out with, that are really pushing to help companies really achieve the results that they need to achieve right now during these times. So active risk, not only foreign exchange, but apparently the biggest risk for most companies, is another example of activating liquidity. Now, another area then is supply chain finance, quite frankly. We're seeing a significant increase within finance of supply chain finance. And we're seeing it for numerous reasons. Probably the main reason is that companies are trying to figure out how to ensure that the supply chain to create their product is still intact. So they have to evaluate who are the suppliers that are key to my supply chain, and do I need to help them financially? Am I in the position to help them financially? And if not, can I integrate a bank to help do so? And so we're seeing companies implementing supply chain finance operations, through banks. They go to their bank, like the HSBCs, et cetera, of the world, and they're saying, listen, do you have a product that can help us facilitate the financing of the suppliers? And by the way, they want to get paid quicker. And as they want to get paid quicker, you, the bank, may be able to step in to finance that. And there will be a cost, but getting financed quicker may be the most important part. If the corporation has their own cash at hand to actually do these financings, then they use a technology that is often referred to as dynamic discounting, where they can use part of their cash to actually gain a higher return. They can help free up cash flows, as well as really focus on helping the suppliers, and with that, helping the company really keeping the supply chain intact. So active financing here is really important, and collaborating with the supply chain, people on the supply chain financing is, A, can be very beneficial, and B, certainly is at this point not just a return on investment from a interest rate point of view, but also one from a very strategic point of view, ensuring that the supply chain doesn't start falling apart. So then as the next part, we really want to look at active payment benefits. And here, and we're going to get to this a little bit later as well, the ERP migrations to the cloud for companies can be extremely expensive, and often will be extremely expensive. As SAP customers are moving to S/4HANA, as others are moving into the Oracle Cloud, but there's certain parts that are not at the core of what ERP systems do. One of those being payments. So while they all put some sort of connector together, it's really not anything but a basic pipe, if you wish, that is very expensive to do the connections, but really doesn't have artificial intelligence included, doesn't have fraud protection included. It's just a basic connector of payments, and for that one gets still charged a lot of money. companies like ourselves really have found ways to help companies mitigate that risk, A, and B, more importantly, significantly reduce the cost of this. And instead of having the ERPs do it, have companies like ourselves who focus on and have always focused on liquidity and therefore payments to actually do that. So here you see a business case. I'll let you read that yourself, and you'll have the PowerPoints to do it. What these areas can do, A, on ERP mitigation, B, on operating costs, and C, on cross-border payments. A lot of technology coming out, which we also support, on really thinking through nuisance payments, which are often extremely difficult to process. They are difficult to investigate as well as account for, because there's lots of fees often involved in these, and the transparency to this is not very well done yet. And there's a great opportunity there to actually streamline that, automate it, and control the costs, as well as automate the compliance parts of these, the governances of these nuisance payments. And nuisance payments I define as anything under maybe $100,000, $200,000, often as little as $500. So automating all that is really important, and there can be a lot of money saved in these areas. We've seen companies of $1 billion in revenue saving $100,000 to $150,000 a quarter in these areas, because they are very expensive to do. So again, another area of active liquidity. As we go through these things, really enhance, and hopefully you get to use this slide internally for yourself, about what are some of the benefits of really thinking about active payments. And I've listed these, though some of these I've already touched upon. But hopefully this is a guide for you to take home and say, let's look at active payments and see, do we have this? Do we have optimized pricing? Do we have simplicity? Do we have holistic compliance and controls when it comes to these sort of payments? They're absolutely available. So as we're talking about cross-border payments here is, this really is a pretty new area of actually automation that can really help facilitate, A, save money, as I mentioned earlier, but B, reconciliation of the foreign exchange rates, reduction in cost of managing it, platforms to process disbursements globally, have that on one platform instead of all over the place, and instead of leaving it to your subsidiaries to go with their local bank to make payments. Start really controlling that cost. There's a lot of money to be saved there, as well as increase in governments and compliances. So that gets me closer to the end of my presentation before we go into into Q&As here. But I want to kind of really focus on a couple of case studies here on the ERP migrations here further. So here's a company, a $10 million manufacturing company, and they're migrating multiple ERP systems, in this case, to an Oracle Cloud. And I'll let you read some of these yourself in there, but the results were pretty significant, with an 85% reduction in cost, IT free to work on the ERP project. I think this is really important. We're not trying to say go and you can save IT costs. No, you're still going to have IT costs as you focus on this, but focus really on the ERP migration itself. And when it comes to areas that are not core to them, think strongly about who can help better do that. That is certainly certified with an Oracle or with SAP, that is a partner of theirs, et cetera, who can really help you on that area as well. And then secondly is another area where we have on this one, as this is a $32 billion manufacturer, which had multiple ERP systems and actually wanted to go into a single ERP system. And there are lots of business cases why to do that and the cost of doing it and the migrations, et cetera, to do that. But again, it focused about reduction of cost. In this case, they reduced their cost by 62% of the implementation, 60%, sorry. They reduced bank system run costs by $4.2 million. In these days, $2.2 million for even a $32 billion company seems to be quite a significant addition by finance to really create value here. They were less dependent on IT, and they reduced the implementation time of the implementations by 14 months. So I leave you with one final thought before we go to Q&A. In these times, and for the foreseeable future, we're actually going to reach back to an economic theme that came out of the late 70s and through the mid 80s, which was called the velocity of money. And velocity of money in the 70s and early 80s, mid 80s even, was defined by the government as GDP divided by money supply. And during those days when the government would come out with GDP numbers and or money supply numbers, the markets would move materially. This is the numbers they were looking for. This is where they wanted to see the indication of how the economy is doing, and we're going to go back to this. We're already starting to go back to this thing, but really the velocity of money, therefore, is, and it is our duty and our belief to ATAR, again, to innovate, to achieve results. These results, we all need to get together globally and accelerate the velocity of money, not just go back to work whenever it is safe, but really figure out how to accelerate paying people, how to accelerate receive the receipts, et cetera, of cash, the ARs, et cetera, and figuring out how to increase liquidity and increase that velocity is going to stick with us for years to come, quite frankly. So with that, I think I'm hopefully pretty close to being on time. I think I just got the message that I've got about 5 minutes here on that. So what I'd like to actually do is open this up to Q&As, and but we'll start off with a poll question.
Great, thank you. Based on the information in the case study shared, has your opinion of the importance of an active liquidity strategy changed? Yes or no? Please be sure to hit the submit button after you fill out your answer. Now's a great time to submit your questions as the Q&A is coming up. You have about 20 to 30 seconds. Okay, we'll be moving on to the results. It looks like just under 59% said yes, and just under 42% said no. Back to you, Wolfgang.
All right, terrific. Thank you very much. Sounds like a lot of people were already on the board of active liquidity and going in that direction, and hopefully I've given you guys some thoughts and questions to bring back into your organization that has added some value here. So on the Q&A areas, we really have a few questions here, and I really encourage you to really think through some of these areas that I mentioned, such as the threat assessment, such as ERP migrations, such as the 4 pillars that really support liquidity and the active network thereof. So let's see here a question. Let's see here, for example, one question I see is, what are the best options in securing the working capital and liquidity needed to enable continued trade? Why also protecting balance sheet from bad debt? That's a really good question, and I don't know the short answer of this thing, and actually I want to make sure that I get back to you on this thing. Securing working capital certainly is an issue to go through. So one of the things that we're seeing is people really evaluating what is in working capital and what should be in working capital. So some people still had revolvers for manufacturing for manufacturing areas in there. So they analyze the data and say, well, we've had this machinery here that's in a revolver. Why don't we pull that out and finance that separately and not have it in a revolver, and therefore freeing up capital accordingly. And protecting the balance sheet is everything right now, especially from the bad debt. Difficult to do, obviously, but being able to analyze the data that's there and seeing who could be defaulting and really focusing heavily on the collections part of this more heavily is important as well. Then another question here is, what have we learned from the last crisis and how does it help us navigate this crisis? That's a really interesting question. So the last crisis, I'm assuming this person is referring to the 2008 crisis. The 2008 crisis was very different from this because it was a financial crisis where the liquidity from the banks became an issue that needed to be supported by the government, quite frankly. In this case, the banks are in very good shape, and they are transparent and really, because of the BIS requirements, supported by the government anyways, but are not looking, there's no talk about bank failures right now. They've done a lot of write-offs, they've secured a lot of things, they weren't as leveraged, et cetera. But I think what we're learning in this crisis is that it's about the liquidity of corporations, and what do we need to do that is not dissimilar to, in that sense, the core problem. Now, one of the things that I'd like to also, in this context, discuss with you is that we really are going fundamentally in a very different direction, which is in part creating the volatility. In the past decade or so, we have certainly been in what have been heightened trade wars. And in trade wars, it is important for the governments to actually manage or allow the management of or ensure that their currency is weak. And we had a race to the bottom. And in these times, we're moving from a trade war to a budget war. And in a budget war, you actually want to have a strongest currency as possible. So some of you may have been surprised if they heard President Trump, who used to talk about that the Chinese have a very strong currency and they're manipulating it, and they're trying to manipulate it to come down, and because they're trying to stay competitive, and that he really didn't want a strong dollar. And now he's very strongly talking about how he's looking for a strong dollar and the U.S. dollar is great. And the reason for that is pretty simple. We're not in a trade war any longer. We're in a budget war where the value of the currency, of what we can do with that currency, is increasingly important. So you're going to actually see people talking about this. Here's another question then. You briefly mentioned velocity of money. Can you share a bit more on that? Well, of course. So velocity of money at the end is the key. And you're hearing people, for example, say, listen, the government has this, the United States government, for example, but you have the same thing in Germany and in many other countries, is they need to get money to people as quick as possible, because not just because they need it, but the faster they get it, the faster they will spend it, and that will have a multiplier effect. So if you receive $10 and you go and spend that $10 now in a restaurant, then that restaurant gets paid faster, and therefore they can take their profits, their whatever $3 of that, and reinvest it, and the other dollars to actually invest. So it becomes a multiplier effect. I lived in Connecticut many years ago, and I lived in a smaller town in Connecticut, and we had about 20 employees there. And one time I decided to actually show the impact of money and the multiplier effect to that community. And so we gathered, this was not easy, gathered $2 bills, and one time period, for a 2-week period, paid everybody their net amount in $2 bills. And it was amazing where all these $2 bills ended up showing up. Obviously, they're very legal, and it was not easy to get them all. We had to go to various feds. But that's a true multiplier effect. That's the impact of money. And if you can speed up getting those $2 bills into the economy, they will keep recircling and therefore keep growing in the economy. Therefore, the velocity of money, and we'll have to all do our part to get payments done as fast as possible, get our receivables in as fast as possible, and then think about where we should be intelligently spending money to support the economy as best we can. Let's see, what do we have? Another one. Let's see here. Okay, I have one of the questions here is, I do not understand how analysts use 1 cent earnings per share as a risk measure. Should the risk be measured as a percentage of EPS, since companies do not harmonize equivalent earnings per share? A very good question. It's been interesting to go through this thing. And the short answer of that is, it's the materiality towards your guidance. And typically the guidance are pretty narrow. Now, obviously, one can have a 10-cent spread in guidance, but you typically don't have a $4 spread in guidance. And so what analysts look at is anything that was unusual from the expectations on the earnings per share. And we have found through lots of surveys over more than 10 years now that when you show a 1 cent earning per share, then it causes a reaction by analysts if they were not used to it. I clearly understand that from a percentage point of view, and I think that's what the question is coming from, is from a percentage point of view, the 1 cent may be somewhat immaterial to some and maybe very material to other. And the person that's asking that question is absolutely right. But we have seen over time that analysts still are focusing on what is material, what needed to be reported. If 1 cent earnings per share impact didn't need to be reported, then it probably wasn't material, and then the analysts aren't going to focus on. But what we are seeing is that 1 cent plus is material. We're still seeing a lot of companies who used to have, I remember one company had 62 cents earnings per share. That was obviously extremely material. Now they have less than 1 cent. The point for the analysts here is the overall understanding over many years that this is a manageable risk and can be managed down to less than 1 cent. Okay, another question here. If an organization did not have a line of credit in place as COVID hit, if it cannot secure one now and cash is less than 100 days, what should their next step be? Revenue plummeted and business resumption will be slow. I think that company, first of all, needs to really review whether their business model is sustainable. If you really didn't have debt in the first place going into COVID and didn't have lines of credit, and now you can't secure it and you have less than 100 days to do it and your revenues are plummeting, really it's time for the board and to see on the chairman and everybody around to look at what do you do, what's the company do, and how can it revitalize itself. We're seeing a lot of companies, look at the high-end restaurants used to never have takeout. Now you can pick it up and it's actually quite good. So they have, but they basically, their top line plummeted to zero in the high-end restaurants. And now they have to innovate it themselves. And, I, for Mother's Day, tried to get order food from a very good restaurant, and we received it. And quite frankly, it was actually difficult to get because the lines were very long in order to get it. So they had to reinvent themselves. So I don't think that's an analytical part as much as it is a strategic business area of how to get revenues back into the company. So these are some of the questions that I'm seeing here. And that brings us to the top of the hour. Are there further questions that there are? Those kind of seem to be the big areas there, or should we do a wrap-up here?
Well, Wolfgang, it's Steve. Maybe I can ask a question or two myself. And it's a little bit maybe different than where some of the questions were going, but I wanted to hear more about your perspective on managing board engagement, during the COVID crisis, particularly around the key financial matters.
Yeah, I think that's a great question that I may not have emphasized enough in here, and I think I'm very glad you asked that question. So The one of the biggest problems that I've seen over the years, and I did a talk on this a couple of years ago with Eurofinance, is that the language of a CFO actually is very different than that of a treasurer and the Treasury Department. The Treasury Department is very focused on, and has been historically, very focused on, we are very cost conscientious. 90+% of our area is about our talent, our human resources, and we have less than 10% to spend on anything else. And that includes even holiday parties. So the issue there is the CFO is talking in terms of earnings per share. The CFO is talking about cash flow forecasting. The CFO is asking questions about FP&A, and those are really the questions that the boards are asking with flexibility. So the first thing I would ensure is that all of finance starts speaking the same language. And I know that sounds a little odd, but I have spoken with so many corporations around the world. This is not just a North American phenomenon where people are very worried about, do I save 1 pip here? Do I save money here? How do I save money, save money, save money? But in reality, when you ask assistant treasurer, I've done this, assistant treasurers of companies, they may not even know their own earnings per share. Hopefully they do, but there are some that don't. Whereas a CFO doesn't get measured at the end of the day by, their bonus is more focused on the earnings per share and the growth of the company than it is the cost. Obviously, cost is associated, and that's part of a bottom line number. Of course, it goes into earnings. But more importantly is managing those earnings per shares and managing some of these ratios that one needs to refamiliarize themselves with. What's the difference between a capital ratio versus a liquidity ratio versus a quick ratio? These are the questions that boards, often growing up during these times of 70s and 80s, like myself, who really are going back to the basics, who are going back to, should we be doing reverse repurchase agreements in order to enhance our cash? So first of all, really getting everybody, the team, the controllers, who's work on procurement, all these things to start speaking the same language helps facilitate for the CFO then the communication to the board. Because if the board says, well, I don't understand foreign exchange risk, for example, not an unusual one if I may go to that one, is how do you actually put that into their language? And there's a very simple tool called the CORE, which is a cost risk analysis, that is something that boards are very familiar with because it is an efficient frontier representing foreign exchange from a VaR versus interest rate differential point of view. And in a very simple depiction, people that are not experts on the boards on foreign exchange can look at risk-reward of the portfolio of currencies impacting them and then show you where they want to be. How much money do they want to spend and what risk are they willing to take? So it is mandatory for the finance organization to have the language and be able to translate it into language that all board members understand. And there are some complex areas that not everybody is an expert in. On purpose, a board should be diversified and should have different focus areas. But when it comes into these days and crises, you need to be able to translate what the business stuff it does to the board so that they can consummate it and discuss it and then do their A, fiduciary responsibility, and then B, supporting the CEO and the C-suite in general to guide the company through these crises. So really important to be able to speak the language of the board and combine that with people within the organization that may be speaking a different language. Thank you. That's a great question.
Yeah, that's great. And I think you may have touched on this a little bit also, and I apologize if you did. But, where, companies are, so one of the things that we are focused on as a company is making sure that the short-term challenges don't have a long-term impact on execution of our strategy. And obviously, we need the right finances, and fortunately for us, we were in a position where we made some good financing moves early on. but where companies may have missed the early opportunity and where either one, they can't get it, or two, it's very expensive, how should they be thinking about managing the connection between what they're funding and what their strategy is, and how to navigate that conversation with the board?
Yeah, no, it's really interesting. It's a great question. I'm sorry if I say this, but I'm reminded of a CFO of a customer of ours who, during this crisis, called us up and said, I'm so happy. This is the biggest best investment I've done because I can actually very quickly maneuver through what I should be doing and should not be doing. And there are others who said, what should I do and should not do, and didn't have the visibility. So then they made the only decisions they could, which were pretty drastic. So, for example, companies would say, I want to bring all the cash back into my home country, just as an example. Or I want to draw on all my lines immediately, bring all the liquidity in. But other companies looked at this and said, for example, I was talking with on a webinar earlier this week in Europe with ACT with the chairman and CFO of GVC Holdings, a €3.5 billion revenue company. And they, interestingly enough, had decided very quickly not to draw on all their cash because they actually said they were able to forecast their cash, said we have enough cash to go forward this. We're not going to draw on that cash right now because it's actually quite expensive to do it. So the first part to the answer, and then I know the second one is the more difficult one, but the first part of the question is, are you now in a position to be able to actually make better decisions? And if not, that should be an accelerator to get to that level, because otherwise one will have a competitive disadvantage in their industry if companies were able to move better and faster than others. Now, if you weren't able to do it, if you weren't able to say, I don't draw it because it costs me money, and you're not able to now evaluate that, then you obviously need to go back with your liquidity to the board and say, here's what we feel is strategic, here's how we are thinking about our business model, and then show and be really ready to show scenarios that go as far as certainly 18 to 24 months out. So the short-term aspects will absolutely already have impacted over the last 2 months most, if not all, corporations. And now they have to live with whatever that was, whether that were great decisions or not great decisions, and then need to have a loop where they said, okay, that's where we were. And if we made a mistake, how do we improve upon that in order not to make that again, and really to figure out how to, again, really focus on achieving results. So what are the results that one does? And it really goes back, finance supporting what is the new business model after COVID, or is it a new business model?
That's great. Thank you. And I think we have another question in the Q&A.
Oh yeah, I see that. Yeah, how does this active liquidity support board conversations? Well, at the end of the day, so this is a very interesting question. At the end of the day, liquidity was not really a main discussion in most companies unless they were financially in trouble, and so companies would look at this once a quarter. But now the interaction has come to, I think I may have mentioned, with Coca-Cola on a webinar where we talked about, when we were talking to them, they said, and this is open, they said, listen, we used to go look at it on a quarterly basis. We're a big firm, we have lots of cash, et cetera. And all of a sudden the board was asking all sorts of questions, almost on a daily basis, not because they're worried, but they still wanted to understand it. And they had a fiduciary responsibility to understand, which was and still remains the critical area, a mission critical area at this time, which was liquidity. So they needed to be educated on what the liquidity were, what the alternatives were, what lines they have, where they have the lines, what ratios look like. Do we have any sort of debt where we may be hitting up against covenants that we need to renegotiate? Do we get to the banks as quick as possible? And then the companies that aren't as lucky as them is, I need to get to the workout groups within consulting firms and the banks in order to figure out how to reconfigure my debts, et cetera, and have those conversations straight. And again, being organized and having the data available makes these things a lot better. So, we've gone through acquisitions where we have, some companies who have all their files very well organized in electronic libraries, so to speak, and that impresses the buyer. And here's the same thing. If it's well organized and you can show visibility to everything that you're doing, then it will be much easier for you to get debt than even if you're a well-run company, but you don't have the visibility. The workout groups are going to demand it. They're going to demand seeing all your cash of the organizations, anybody who's getting increase in debt financing. The banks are going to tighten up these credits, hopefully not, but I think that's what we're seeing. And so the people that have their house in order and can show the liquidity will see it. We're seeing already incoming demand for us, where banks and consulting firms are actually asking us to support them for their customers to create proper visibility into their entire liquidity networking. So I think that's really important to do. We've got a couple more questions here, and I think we've got 5 minutes left, so let's try this one. In times of crisis, it is easy for a board to focus on the importance of liquidity. What is the risk of boards reverting to the old way of focusing on quarterly updates after the emergence from the crisis? Interesting. I think that when one goes through a crisis like this, it will take a long time to go back to the norm, and likely never. I feel pretty strongly that we've been, as I mentioned before, we've been looking to innovate to achieve results, to ITAR. And the results were in the vision of our founder and the vision of my esteemed, and I'm honored to be with 700 colleagues around the world. Our thing was always about that liquidity, quite frankly, was undervalued and was underestimated. And this crisis has really brought this to the forefront. Years ago, I really reinvestigated the capital asset pricing model, to give you another, maybe a little bit off the side of liquidity from the capital asset pricing model. I reviewed because of the 2008 crisis, which also was a real estate crisis in a way, obviously. And during that time period, and still now, capital asset pricing models really did not take liquidity into consideration, and don't still to this day. So there was a time actually where having $1 million in the bank was valued less than having $1 million in a house. And obviously that goes against the principle of liquidity, and they found out that $1 million in the house was all of a sudden worth a lot less than having $1 million in the bank. I saw an article not too long ago that I supported, which actually said cash is king and queen. I think that's politically very good. I really like it, but it's very appropriate. So I think that this crisis, for a long time, will emphasize and focus on liquidity to come, and we will not go back to just some quarterly reporting. Obviously, things will maybe quiet down somewhere, and this is interesting, when the boards feel that these areas are under control, they'll ask less questions. So, one time I was surprised. I was talking to a CFO of a very large company, customer of ours, and I asked her, I said, well, how often are you guys still discussing foreign exchange at the board? And she gave me, her answer was, oh, we don't discuss it anymore. I was shocked. I said, you got to be kidding me. Isn't this no, we have it completely under control. We have one slide. We used to have 50. One slide that talks about, here's our risk exposures, here's the risk of the exposures, here's our net, and they know that we have processes in place that take this, and we have no surprises there, so it doesn't come up. So the boards may be asking less once they feel it's truly under control, but it will remain as a mission critical area for boards to think about, and CFOs to guide their organization, and CEOs to guide their organization towards visibility of liquidity and all the 4 pillars that are associated with it. Really great question. Thanks, Dennis. All right, so looks like we are running out of time here. There's a couple more questions that just came in. Do I still have time to answer these, or are we at the 75 mark?
Hi, Wolfgang. It's Kelly.
Yes.
You can do one last quick question.
Okay, great. I'll do that then. As we all know, the federal government has enacted a number of measures to provide relief to U.S. businesses affected by COVID-19. Yes. What could be the government do to help companies' liquidity challenges? Well, they, at the end of the day, need to be working very closely with the banks to actually loosen credit, quite frankly. I think that's the biggest thing that they need to do, and they need to learn to do. First, they needed to inject liquidity, which they did, and now they really need to think about how to more intelligently do that. There's a couple areas that I feel very strongly about. One is that of really working with the banks to ensure that they're not tightening credits to the level that people can't get credit right now. It's really important because you're typically not going to that. And I think that's part of what it is. And then the government really needs to start thinking about, are the policies that we put in place, the fast fixes that we did, the right ones? So, for example, I feel strongly that the government is right now subsidizing unemployment and almost motivating people to stay home, to not go back to work because they will continue to get unemployment. So really thinking through is how to get people back to work now that they've been bridged during these tough times. And I admire companies such as ourselves and Starbucks, et cetera, that have never spent one day of furloughing and being able to do that. Well, other folks, unfortunately, were in a situation where they had to. But the government, at the end, needs to work with corporations and the banks to finance those things to get people back to work and get this economy going. I think that's the part that I'm very passionate about, is not motivate people to stay home with the unemployment that they're doing, but really motivate people to go back to work. Thank you. I guess that was the last question. Thank you all very much for your time and interest.
Great. Thank you so much. This marks the end of our session. Thank you to our speaker for today's presentation. If you have any questions regarding CPE credits, please feel free to email conf@financialexecutives.org. Our next session begins at 11:30 a.m. Look for the call to action window to bring you back to the engagement hub. And don't forget to download your CPE certificate in the certification widget now. We look forward to seeing you on the next session. And again, thank you.